Hello viewers, welcome to my channel. UK has caught in a vicious cycle of high interest rate, high mortgage payments, high rent and high cost of living. Besides, the country is facing worst housing crisis. Rampant house price growth in recent years has far outpaced pay rises, and now sky-high mortgage rates will add to the pan. According to Moneyfacts, the average 2-year mortgage rate has climbed from 2.59% to 6.8% since June 2021. The average 5-year rate has risen from 2.82% to 6.32% during the same period. Analysts believe that if mortgage rates stay at 6%, the proportion of people's income spent on mortgage repayments will return to the levels not seen since the late 1980s. It would mean over half or 56% of people's income go on their mortgage repayments. It's difficult to anticipate the future mortgage rates. However, the following variables are likely to cause another Bank of England rate hike and will be a subsequent jump in mortgage rates in August 2023. Hence, more mortgage payments are coming. It may cross benchmark of 7% as the Bank of England increased the rate by a quarter in August 2023. So the mortgage pegged with the interest rate, it may also increase. The number of families and individuals facing homelessness in England is its highest since 2018, sparking calls for the government to reform renting laws and building more affordable housing. Britain is in the middle of a cost of living crisis, with the high rates of inflation leaving people struggling to pay for essentials and meet rapidly rising rental prices. Reuters poll showed the Bank of England will raise its bank rate by a quarter point to 5.25% on August 3, making borrowing the costliest since early 2008, and hike twice more by early and as price pressures persist. Despite 13th consecutive rate rise since December 2021, the Bank of England is grappling with the higher inflation than its peers at nearly 4 times the 2% target. Economists are more hawkish than they were a few weeks ago and are nearly evenly split on forecasting a final quarter point move to 5.75%. International Monetary Fund has warned interest rates in the UK will need to stay higher for longer than previously forecast in order to tackle stubbornly high inflation. The bank's Monetary Policy Committee meets next week with the financial markets on the balance, expecting the next move to be a 0.25 point rise to 5.25%. Growth in wages. Wage price spirals. Price and wages accelerating together for a sustained period. Public sector pay growth has hit its highest level in 22 years in a blow to the Chancellor's ambitions to rein in inflation. Pay growth is one of the key measures the Bank of England watches for signs of inflation become embedded. Governor Andrew Bailey warned that both prices and wage increases at current rates are not consistent with the inflation target. Office of National Statistics figures showed private sector pay grew by 7.7% in 3 months to May, the fastest pace on record outside the pandemic. Across the economy, average regular wages rose by a record equaling 7.3%. In the wake of the latest wage data, traders ramped up bets on another 0.5 percentage point interest rate increase at the Bank of England's next monetary policy meeting. Another outsized increase would take the base rate to 5.5%, the highest level since late 2007. Core inflation is still high. It comes after official figures showed inflation in the UK fell to 7.9% in June, which was down from 8.7% in May and below the 8.2% expected by economists. This was down from 8.7% in May as petrol prices tumbled and food prices slowed. However, the core inflation rate for the UK was 6.9% in June 2023 compared with 7.1% in the previous month. Core inflation measures the inflation without food and energy prices, which can be far more volatile than inflation for other goods and services. Core inflation, which excludes the volatile energy, food, alcohol, and tobacco prices, remained sticky at an annualized 6.9% but fell from 31-year high of 7.1% in May. Food prices rose 13.3% in June from a year earlier. That's still high, but food inflation has fallen from a peak of 19% in April. The easing of price increase also helped to pull down the overall rate of inflation. Headline inflation rates have declined, but policymakers are closely watching other measures that signal how deeply inflation has become embedded in British economy. Price rises in the services sectors and pick up in wage growth are signals of persistent inflation. Among the reasons the Bank of England has raised interest rates to the highest level since 2008. House prices and housing supply is falling. UK house prices fell at their fastest annual pace for nearly 14 years in May, the Nationwide has said. The Building Society said prices in the year to May dropped by 3.4%, the biggest decline since July 2009. Mortgage rates have risen recently on expectations that the Bank of England will have to lift interest rates again because of stubbornly high inflation. House prices have fallen at their fastest rate in 12 years, according to the Halifax. While mortgage rates continue to rise, the high street lender said the annual fall of 2.6% was equal to around £7,500 being wiped off the average UK house prices, the biggest drop since 2011. Moreover, construction of houses also hampered due to over environmental regulation and protection. The chairman of the Federal Reserve has warned that the battle to contain inflation is not over as the US central bank raised interest rate to their highest level since 2001. Policymakers voted to raise interest rates by 0.25% to between 5.25% and to 5.5%, piling fresh pressure on the Bank of England to do more to stamp out soaring inflation. Prices in the US climbed 3% in the year to June. This is the slowest rate in 2 years and down from a peak of more than 9% a year ago. The Federal Reserve approved a much anticipated interest rate hike that takes benchmark borrowing cost to their highest level in more than 22 years. Bank of England rate hike prediction. UK inflation stood at 7.9% while core inflation about 6.9% over the same period, highlighting the challenge facing the Bank of England as its battle to keep a lid on price rises. UK policymakers are expected to raise rates for the 14th straight time next week from 5% to 5.25%, with financial markets betting that rates will hit 5.75% by the end of this year. It's important to keep in mind that the base rate is still expected to rise again. What has changed following the latest inflation announcement is that its predicted peak is being revised down by the market and many financial experts. Inflation reading of 7.9% dropping significantly from 8.7% in May and beating the forecasted 8.2%, it seems that the action the bank has taken already may be working more effectively than originally thought. While the situation around inflation is improving, the rate is still high and Bank of England will want to continue with its strategy of regular increases. But the pressure of having 0.5% increase in August has receded. For those with a variable rate mortgage, including tracker mortgages, where the interest rate follows the base rate, it means there is probably more pain to come. If the forecasts prove accurate, the only consolation is that any future rate increase may not now be as large as they could have been. The next base rate announcement is on 3rd August. Thanks for watching. Please like and subscribe my channel.